Welcome everybody to Stick With It, APA's podcast for its pilots. My name is Andrew Taylor and it's my great pleasure to welcome you to the new season of our podcast.
Hello everyone. Stephen Furness, myself and my colleagues Ian Fraser and Robbie Parkinson are financial advisors and representatives of MGD Wealth Limited. Any advice included in this podcast is of a general nature and has been prepared without considering your objectives, financial situations, or needs. As such, you should consider its appropriateness having regard to these factors before acting on it. Before you make any decision about whether to acquire a certain financial product, you should obtain and read the relevant product disclosure statements, and you should seek professional advice from a suitably qualified advisor. Mortgage broking is provided through our partner business, MGD Lending Solutions Proprietary Limited, which is authorised under LMG Broker Services Proprietary Limited. Nathan Huney is an employee of MGD Lending Solutions Proprietary Limited and is authorised to provide personal credit advice under LMG Broker Services Proprietary Limited.
This is part 2 of our chat with the experts from MGD Wealth, who are fantastic supporters of our show. Today I'm joined with Robbie and Stephen. Please introduce yourselves, gents, and so the listeners and watchers can catch up with what we've been chatting about.
Yeah,
Robbie.
thanks, Andrew. So I'm Robbie Parkinson. I'm a private client advisor and sit on the investment strategy group at MGD Wealth. We really value the partnership that we have with APA and appreciate being here today. Andrew, I'll hand over to Stephen.
Yeah, thanks, Andrew. Robbie. Stephen Furness, director, shareholder, and private client advisor at MGD. So with help, I head up the wealth management advisory efforts here at MGD Wealth and work with great people like Robbie and our extensive team, many of who your colleagues, APA members, would have a relationship with. So
luckily to have one of the bosses and one of the owners with sister. We have some background about MGD Wealth? You said 40 years you've been involved in this part of the industry. So just a little bit about MGD so our listeners can understand.
22nd of July, 86, I started full-time work. So I might take a day off coming up.
Not yet, no.
So MGD Wealth, the group, MGD Group is 50 years young or old, late last year, which is a great milestone. We're a diversified financial services and accounting business. We have 75 odd staff, colleagues. So we're a meaningful business situated in Brisbane, but have clients nationally, which is great.
In Adelaide, like me.
Yeah, in Adelaide, yes, that's right. So we're a big wealth advisory business across the retail as well as the sophisticated client space. We have a great advisory offering there. We're a tax practice, many like
me as well. Yes,
like you, Andrew. We help you with your tax. We've got a great insurance, business, personal, and business insurance. Lending solutions is a relatively new part of our business. Self-managed super advisory. I think that's about it.
That's about it.
So well diversified. And then the thing I love about our business, I've been there 18 years this year, is every one of our specialty areas has highly specialised experts. Owen that helps run our insurance practice. Owen's one of the best insurance practitioners you'd come across. Nathan, running lending solutions, is out of CBA Corporate and HSBC before they are very specialised subject matter experts. So bringing that team together, we've got a lot of tax partners, ex-Deloitte's, highly qualified tax partners. So that's what I love about, we're able to dial in solutions as needed for our clients, relevant to their requirements. So
But what is really important is you understand and have clients who are pilots, so you understand us as individuals and professionals, I guess.
Yeah, so we do obviously really appreciate the APA relationship and
We've got Wallace over the back there that
Yeah,
helps us a lot.
he does, absolutely.
So yeah, it's been a great relationship.
Yeah, I was actually working with one of your members yesterday, implementing a strategy for them. And to your point, Andrew, we could do anything for anyone really, but it's the core of getting to know the clients, the individuals or the family, or what it is that they require that allows us to, use our IP and our skill set and effectively pull off the shelf the tools that we see most fit to be able to form up what works best for them. And that is always evolving. So that provides us a lot of interest as professionals, because what you're doing is always evolving. It doesn't get repetitive and boring in that sense. But importantly, we all get a significant reward of seeing a client sit there and understand, okay, well, with this work that we're putting in front of them, what we'll do for them going forward, that gets them to achieve everything that they want to do, whether that's building themselves up to retirement, or they're managing that retirement and not having to worry about anything, knowing that we're in their pocket and in their ear as much as they want us to be, or otherwise, because that's fully catered, the service to the client. But they know with confidence that they can go out to work and jump in the cockpit, and everything's looked after for them and their family as they go into retirement and then beyond.
Reassuring. Can we talk a bit about this? You spoke about the investment strategy in the committee that sits. I would have thought investing ChatGPT, I can put in, I've got $7, I'd like to invest it. And it has some wonderful ideas,
Yeah.
But obviously, it loves your advice. Every time you ask a question, it comes back, that's a great question, Andrew. Yeah. So let's talk about putting in a real life people around a table talking about how to invest our clients' money. That's a lot of pressure, being very cognizant that if we make the wrong decisions here, this is people's, quite often their entire wealth we're dealing with. So that must be an interesting table to sit around.
Yeah, well, for us, it starts with having really good governance processes and systems in place. And just in late January this year, Robbie and I recorded a governance sort of reminder webinar for our clients to reinforce, because we have seen in recent years another industry-wide governance failing that ultimately impacted a lot of mum and dad Australians.
Do people just get caught up in busily running their businesses that slips by, or is that malicious?
But they can be high-pressure sales involved, targeted at clients with smaller super balances that
we can get a fantastic return for your money coming to us.
Gaps in knowledge and understanding and assessment of risk as well. Like even
by the individual or the person offering the advice?
Well, depending on the directive that the client's got to allocating that capital. If that's been self-directed, then of course, right? Yep. If it's not your scope, you're not gonna know a lot. But even in professional realm, there's various capabilities and understandings of things as well. So, even within the broader advice realm, there's different practitioners that have different strengths and weaknesses, and that can come out in certain things. And that's no different to any other industry or profession that's out there as well.
But with the governance, Pete, the things that ultimately clients pay for when they've got an advice relation, from a governance point of view, they should expect that we know, like with an investment partner firm, big fund manager, how their investment committee works, how they make decisions, what's their fraud protection strategies, right? How do they price assets? There's a whole, long list of governance protocols that we expect of the investment managers that we're ultimately recommending to clients. What's their offshoring policy? What's their privacy protocols? How do they protect clients from cyber risk, right? All of that comes under the realm of good governance, right? Now there's ChatGPT, you talked about that, but even the Rich Dad Poor Dad, all that's been great for investor education. right? And the more financial literacy Australians get, the better. Where we try and make sure is build on those foundations that clients self-educate themselves on, which is great.
Yep.
Is then to make sure that there's really good governance wrapping around, our investment philosophy. We're a goals-based investment firm, which is essential, and then making sure the implementation for clients, their portfolios, super funds, could be art now, for
handles the Qantas accounts.
yeah,
Absolutely.
it's super critical, right? And that's where in the past these failures of investment products that come, unfortunately, every few years. Luckily, MGD hasn't been exposed to any.
Yep.
They all come because of a failing of governance, and there's a price for that, right?
Of course, absolutely. So a couple of things while I think about it. Robbie, you said you're agnostic, talking about who you invest with. You're agnostic with where clients' money goes, so you'll go looking for what you're most comfortable with, or who you believe are doing a good job at the time, things like that.
Yeah, that's right. Basically, sector specialists, right?
Explain that term to me, if that's okay, Stephen.
If you're a really fantastic investment manager in
mining's a classic one. Can we use that one?
It could be, or Australian smaller company stocks, right?
Yep.
And there's a whole range of fantastic investment managers that just focus on that sector, as an example, right? Or property or infrastructure. But if you're a really good infrastructure manager, you're not necessarily going to be a great manager of international equities, right?
Yes.
So ultimately, at the end of the day, our clients, most of their capital, we do have some index type exposure, but most of their capital is invested in subject matter experts, fund manager, like infrastructure managers or property. So the specialization in terms of active management, in terms of driving returns over time, is a big part of our process, right? Now, we're mindful of costs,
Well, that was my next question. Is there a lot of extra costs when you can drill down to being that bespoke?
Yeah, and that's where you want them. You need to get the value out of them,
okay,
from a performance point of view. Or it could be they are able to generate a return with a lower risk profile. So risk is a attribute as well that we look for. So,
and should that change over your investing career, that level of risk, or is that so bespoke to an individual that even at 90, some people still like carrying high risk in there?
Sometimes.
Yeah, definitely. And, even in that situation, if someone's a 90-year-old, their assets might be for not just them, but the purpose of those assets are for the next generation in their family, and their investment time horizon might be much longer. And where investment time horizon is important is, if you need money in a few days, you wouldn't put it in the stock market because it could be down heavily in that period of time. You don't have enough time to recover. But as you have a longer period of time to invest, your risk goes from price volatility, putting in $100 and not having a value of $100 to withdraw, to not being able to keep up with inflation or growth, or otherwise it's just broader opportunity cost. I've invested in this, I could have invested in that and done much better, and that gives me optionality. It's not just chasing returns. It comes back to, what does that higher value of your portfolio allow you to do for yourselves and your family, and that's the key there as well. So yeah, the risk conversation that we have with clients is deep and detailed and customized to them and their scenario, because this leads to the question of how much is enough to retire on in super.
Yep.
The reason that there's no answer is that the answer is it depends, like most things.
Yep.
And that's very different depending on the family and the individual and their priorities and their objectives and what they want to do. So there's a few different things to think about with risk. There can be pure investment risk. So do I put money in cash? And I know there's little investment risk there, unless the banks blow up. Which probably wouldn't be worried too much about your money at that stage. We've got bigger things to worry about.
Absolutely, yes.
Or you put your money in shares, and there could be more volatility there. That's one thing. But then there's also strategic risks. So, if you've been a little late to considering retirement and looking further up the road, and you're a little bit behind of where you should be on track to achieve the things that you want to do in the future. And again, what we're looking at there is how much you need to retire, is what's a suitable amount for you to retire on to give you the retirement income that you need. So if you need 100 grand or 150 grand or 80 grand,
whatever,
it's all going to be different, right? But if you're not taking enough investment risk to get your portfolio to grow at a certain rate, to put it in a position to be able to facilitate the future income that you need to draw from it, well, that's a strategic risk, and that's also a conversation. But then there's other things to consider as well, and other risks that we manage. So commonly, there's a timing risk, or something that's considered sequencing risk. So you're coming into retirement, your balance on your super as a key asset to provide your retirement becomes a bit more vulnerable. Mm-hmm. Now it's not if you've got a defined benefit fund, which is really helpful.
Yes,
for,
it is.
For a lot of members.
Thank you very much to Hudson Fish in 1939 started the Qantas Super Scheme, so I will be eternally grateful for him. Absolutely.
When you leave that's your big risk management point, right?
Touch wood, for 30 odd years, I haven't had to carry that risk, and that's through good luck, not fortunately.
Yeah.
But I don't know how I'm going to sleep at day one. From then, all of a sudden, the risk now comes to me, and
and there's this concept of flicking from human capital to financial capital. When we're working, we're building up, we're taking advantage of our human capital and being an employee.
Okay.
Our earnings capacity, rising up the ranks. In terms of executive roles, that's all human capital, right? You that suddenly switches off.
You have to crystallize it at that point,
right? And you're totally operating on financial capital. Your balance sheet, super, and maybe an investment property, etc. Right? So that morphing, it's a completely different mindset, right? And then you overlay that with this concept of retirement risk zone. Your capital peaks.
Yes, and then
like maybe a couple of years before retirement, and maybe that 3 or 4 years after retirement. For most people, obviously there's exceptions, but that is the 5 or 6 years of their whole life where capital levels peak. Because they go into
frightening.
they go into drawdown
and then you have to start drawing down on it.
And you're not averaging into the market. So if there's a market drawdown and you're still working, you're still contributing to your portfolio, well, you're buying the market at a discount, whatever you're investing in.
Yes.
Right? You're buying at a discount. Now, if you've retired and you've not structured your portfolio appropriately, you might need to sell those assets at a discount to provide that income for you. So again, the pre-planning is really important and can have material impacts. So there's research that's done on this that can show that there's material impacts on the long-term sustainability of a portfolio based on assuming a certain dip in the value of the portfolio at certain periods of time, whether it's just before your retirement or just at your retirement or after your retirement. And that means that you might be short a few years in terms of your retirement income funding, and then that's a concern that needs to be managed otherwise. So the planning of these things is really important, because again, and we've spoken about it a little bit on the investing side of things. That's really important in terms of the execution of the overall strategy, but the core of the strategy comes to, Andrew, what do we need to do for you to make sure that things are robust, that they're predictable, that the probability of you being able to do what you want to do when you want to do it is high, because that's the outcome that we're looking to achieve, to give you confidence and then optionality.
So we're chatting with Robbie and Stephen from MGD Wealth today about some investment strategies and just some background about MGD, who've been a long-time supporter and partner with APA. So what's a traditional portfolio of investment look like these days? Like, I guess that's like a traditional Australian family. What's that look like?
Yeah.
So
different.
what's a traditional investment portfolio look like? Is there such a thing?
Yeah.
Well, what is common, they're all different in a way, but what is common is that goals-based framework that we operate, right?
So does that mean the goal is we want to get a 10% return for the next 50 years? Is that a goal?
No, it's more to do with what Robbie touched on with the cash flow expectations.
So we need to fund this for this amount. So our goal is to have.
Yeah.
To be
So
able to fund
Andrew wants to retire in 3 years' time.
6. And I want to travel around the world painting. So that's my.
Well, let's go with
like
6, right?
Yep, 6 years. Let's work on that.
And we assume that Andrew is getting enough cash flow from employment-related activities for the next 6 years.
And I'll just add, to anyone junior to me, that's not an ironclad guarantee. That's indicative only. And so
everything can change.
Correct.
So we can then talk to Andrew. Let's say you weren't in defined benefit, right?
Yes.
Let's just say you had a more normal super. We would educate and sort of come to an agreement that for the next 6 years, your portfolio, super and external assets, don't need to generate cash flow for you, any additional cash flow.
So you're still in that investment
You're still in the accumulation phase,
that's
right?
a better word.
So in theory, your superannuation strategy, if it was an accumulation strategy, different for defined benefit, can take a medium. We know we're not needing that capital for 6 years.
Okay, right? So that comes back to the risk we were talking about.
Yeah,
the level of risk.
So 1 to 6 years for us as a general rule, we don't recommend much risk at all for clients.
Yes.
A little bit moderate, but we're not taking huge equity market or property market risk for capital that we know clients might need for the next 5 or 6 years.
Okay.
It's just too much of a risk.
Okay.
There's too much risk of an economic cycle, downturn, etc.
So we're not pouring into the Turkish lira or the Fijian kina or...
No. So 6 to 10 years, is where people can start taking more sort of balanced, diversified type risk levels from us, from a philosophy point of view. And then 10 years and beyond for us is longer term investing, right?
Okay.
It's generally when economic cycles sort of run in, 8 to 10 year periods. And that's where we can start educating clients that you've got a 10-year money, you've got a long-term time frame. And for the right people, there's always conservative clients no matter what.
Yeah.
But we can start educating them about, really good portfolio design or longer term capital where we know that we don't need to draw cash flows from their portfolio. But then in a few years' time, Andrew's not 6 years from retirement. He's only 2 years from retirement.
Yes.
Because, passage of time. We would specifically, and we do it for all our clients, specifically start to reposition some of that capital because we know that Andrew wants to draw $120,000 a year, only just around the corner. It's only a couple of years away. So we would start working with you to, reposition some of the capital to make sure there was some shorter term, more risk, more defensive capital.
Yeah.
So the framework applies for all our clients, but then clients have a different journey that fits within that framework.
And do you get many clients to come and say, Robbie, I want to invest in this, say it's small CapEx, and you go, that sector's fine, but I prefer this fund compared to that fund or this manager. Is that the sort of advice that's appropriate? Well, it is appropriate because it's, we pay you for the advice. So is a relationship like that quite, right down to that level saying, I saw this on TikTok, as I was saying to the boys before, this fund manager, he's a gun, I want to put my money with it. And you'll go, that's fine, but, these are the risks involved with that.
Yeah, for sure. It's an education process as well because, in investing, it's easy to see what the potential upside is, especially when markets have been as strong as what they have, really since the GFC. Like we've all forgotten that
Very short
in late April last year, the US market was down almost 20%.
Completely forgot. Was it?
Rocketed since, you know.
Yeah.
No,
What
no
was
idea.
what was COVID?
Yeah.
You know.
Yes.
So
Yeah.
all of these things come and go, and we can become overconfident. So there's certain heuristics and mental biases that we have as humans, which make us human, which are great. But if we're thinking about things through our financial or investment lens, we need to be mindful of those things as well. But again, returns or past returns, and then projecting those forward to future returns is easy for anyone really to see. What's really hard to understand is the risk. And that could be as simple as drawdown risk. You know, you invest in the ASX 200, you diversified so you don't have concentration risk of one company going well or otherwise. So your risk of total capital loss is very minute. But that doesn't mean that the portfolio can't drop down 20%. So that's one thing, understanding that. But then if you're managing that portfolio, it's understanding the governance, as we've spoken about, around the mandate of that portfolio. Is there something here where how the portfolio has performed is unlikely to be how the portfolio will perform going forward? So if you've seen something on TikTok and there's a gun manager and they've done, you know, great returns, first thing would be the returns are too great. That's a question mark as well. How they get there, because you can be smart and you can be lucky. Generally, you're best off being lucky, but in our world, you need to be smart as well, because your luck will dry out. So that leads to the not all eggs in one basket, because there's always a rotation in the market. What was hot last year won't be hot this year, and that hasn't been been the case. You know, it's a bit of a sailing or even a flying methodology. The wind always changes.
But people are just shuffling around. This is a good idea at the moment, or they like this, and money's moving around for no particular reason.
There'll be particular
reasons,
but again, there'll be drivers of those change. So that might be interest rates. That might be the Australian dollar. It might be more sector specific as well.
But there are data. Like I don't want to critique a great Australian company too badly, but
CSL.
But CSL,
Oh,
right?
really?
Yeah, totally.
TikTok, yeah.
It was $330 a share.
I
not
have
so
4
long
of them.
ago.
My darling daughter has 4 CSL shares.
Yeah.
Yeah.
And now it's 90, I think today,
Got
96, 97,
Really?
right? Because they've had some management problems, right? And earnings downgrades. They've had problems with the US market.
Mhm.
And when it was $330 a share, it was obscenely expensive on any traditional
Or any metric, was it?
measure, right?
Mhm.
And so when stocks get like that, some of those market darlings, they are so sensitive to any fraction of bad news. And stocks, you know, companies go through bad periods, right? Like
Absolutely.
That's the reality we live in. And so that's an example. If you were, and you know, I know we've got examples of it, but you know, if you're overly in love with a stock like that,
Yes.
it can have a huge impact on your balance sheet. If it's a relatively modest position in a broader portfolio and you can absorb that sort of impact, well, that's okay. But some people can't, right? They get too in love with a stock and it ends up being 40% of their portfolio or something like that, right?
And that's a good point of what you started with, was if someone does love a position or has something there. Commonly, we have clients that are onboarded where they've just got such a unrealized CGT liability in a position that it doesn't make sense to get out of that position, because we might sit there and say, okay, well, for what you want, this portfolio construct is best for you, but we've got to consider the costs and the taxes to get from where you are to where you want to be.
Washes out any benefits.
So then it's about working with the client to understand, okay, well, what does this mean to you? Some assets, they might be passed down from generations ahead and they're sentimental. There might be other reasons why someone wants that asset as well, or they might have a relationship previously that we work in with. So then it's a matter of, does it make sense for that asset being in the portfolio, and then how does it complement the whole portfolio so there isn't too much concentration risk in there as well? Because again, portfolio is about how do we get the right outcome for the client that makes sense to them. And back to your initial question about traditional portfolio, it can be very broad these days because there's been a lot of development in financial products. There's so much that's available to clients these days, which is always a double-edged sword. There's more optionality, but there's more things, not necessarily that could go wrong specifically with the product, but without guidance around how to pull everything together. Because again, with something like CSL at 300, it's a great stock, but if it's intrinsically worth $250,
it's not a $300 stock, is it? Yeah.
And everything has a floor and a ceiling.
Of course.
Right? And if you're buying it at the ceiling, you've got more downside than you've got upside. Now that's hard to say where the floor and the ceiling is, but that's why, again, we work with specialist managers who are specialized in their investment discipline, and why we don't have investment managers who do Australian large companies as the same people who do Australian small companies or infrastructure and other types of assets.
And are you able to pick up the phone to those type in managers and say, what's this? What are you doing? Like, I don't understand. Like, is the relationship that sort of relationship where you say, why have you just bought this? We said, or got out of that, or
we had in Brisbane yesterday had a meeting with one of Australia's best investment managers when it comes to the hybrid note market.
Okay.
Great track record and just one of the, and I really enjoyed talking to them. The amount you learn from these experts is phenomenal, right? So we had him in. We're catching up with a venture capital manager we've got a partnership with next Tuesday. That's one of the things I really, obviously the client side is the best part of my job, but the investment specialist interactions are professionally really enjoyable too.
And the responsibility and privilege of helping clients manage their capital, and the purpose of that capital, whatever that level isn't ever lost on us. Like, while Nathan and Ian were recording their podcast with you, we're out the front having a conversation about, is there things that we can do to improve and elevate our processes to ensure that level of accountability is at the highest degree? Because for us, it's not about, okay, we want to work with people that are good in terms of their ability to add value to a client's portfolio, in terms of those investment managers and the consultants and the research groups that we use, but how do we use the best, and then how do we maximize them for our clients? And you mentioned fees before. Yes, there's a cost anytime that you're going to use a specialist, but it's looking at what is the value that we're getting from using this specialist? Is that worth the additional cost relative to, in investing, an example is just using an index where you don't have to think about anything, and you just buy it. So how do we ensure that the client is getting the best outcome? And again, back to your initial point, if we're just partnering with one investment house, how can they be the best at everything?
So in the good old days, the game investor would go to the market, Africa or the Americas or the Japanese market. How's investing strategies and markets? And I spoke to the boys briefly about private markets, or the deals done at the Tattersalls Club in Brisbane or the front bar of the Brecky Creek Hotel. Is it that macro level? Is there money circulating? People looking for money and investment in that low level, or not low level, but that's more, I guess. I'm interested in that.
Yeah, the Brecky Creek Hotel. I've been there for a while. I need to get back there.
Have a pot of
big
4X off the wood, absolutely.
Yeah, that's right. Yeah, well, the big evolution, maybe the last 10, 15 years, has been in the private markets side of investments.
But that must be very difficult to run governance over.
Well, yes, there's more governance to do. So yes, you're right. It is more difficult, but in every single asset class, even fixed interest, right?
Yes.
So fixed interest, the share market here, the share market overseas, or equity investing here and overseas, property, infrastructure, every single main asset class, there's ways to access those in listed markets.
Yep.
or unlisted markets. So there's actually, like from a, say, global equity investing landscape, right? You buy shares in Apple, for example, right? Global share. There are about 4 to 5 times the number of investable companies available that are held privately than there are on the stock exchanges.
Unlisted on public stock exchanges, really?
Same with property. You know, the amount of property held privately. You know, this is investment grade property versus listed is a big ratio. So to run a portfolio just on listed markets means you do miss out on a huge universe of proper investment grade.
Wow.
We're not talking about fly by the night stuff.
My mate's milk bar on the corner.
Yeah, we're not talking about that.
Really?
We're talking about investment grade, investable companies or property projects or infrastructure projects. The challenge is that private market. So all of that unlisted market is called private markets.
Okay.
They're interchangeable, those terms.
Okay.
Right? The differential is the liquidity profile, right? If you're a client for whatever reason, there's sometimes good reasons, but sometimes there's reasons that don't make a lot of sense. If you want all your capital to be able to be liquidated in a short amount of time, needing high liquidity, then yes, you stay in listed markets.
Yeah. Because you can literally dump it on now. We can make it.
Doesn't mean you're going to get a good value.
No, but you can get your cash and it'll be in your account instantaneously.
Now, we spend a lot of time talking to clients about, you know, you probably don't need all your capital, your entire balance sheet listed and been able to liquidate it overnight. And then that provides an opportunity through high quality, you know, private market opportunities. Like down here in Sydney is one of our one of Australia's best infrastructure managers. They're a private markets, you know, a big healthcare property manager that we do a lot of work with. They buy, you know, direct healthcare property assets. That's a private markets. So you know, a lot of high net wealth Australians, more sophisticated Australians do a lot of investing in private markets because they've got the right time frame, they've got surplus capital, they don't need as much liquidity as other investors. So it's a huge universe, and the investment grade or the investment merits of some of those opportunities are just incredible if you've got the right time frame and the right, you know, liquidity profile. So for the right clients, we do a lot of work with research consultants and managers in that private asset space, and you know, there's some fantastic opportunities, right?
Well, I'll assume that I was the only person listening that didn't know that. So,
but to be honest, through your art super fund, right? All the APA members that have art is a huge investor in private markets.
There you go.
Investment. So if you got to be able to, don't worry about the defined benefit, but if you're in the art growth fund,
it's got money invested in those private
a lot.
I was looking at the high growth fund for a client the other day, and it's about a third of that's in unlisted investments.
And they do a great job. I've met the private markets portfolio manager at Art, and they've got the scale to buy some of the premium assets around the world. You know, big airports and things like that. So indirectly, most super fund members, whether APA or anyone, would indirectly have a lot
market.
of.
So I guess that's incredibly reassuring. One, that now that MGD is able to consult in that space and talk to your clients in that space, it's also reassuring that any of our members who have money in art, you know, that confidence coming from a third party saying, well, actually, you know, art does, they do things well. So while I could sit here and listen, because I'm getting it for free at the moment, so I'll take all the advice, which is great. Forever, can we just some little takeaways, Robbie? You know, 3 points about that investment part of somebody's portfolio, I guess.
Yeah, I think taking away the 3 things that are most important, having a good think about what you need your assets to do for you, because that drives what is most suitable for you. And that could be as simple as, hey, I want to retire next amount of years, as we mentioned before, 6 years on $120,000. a year. So I've now got to start thinking about, okay, well, does that sort of marry up with how much I've got?
Can I do that?
Can I achieve that?
Yep.
Does that mean I need to start tipping some more money in or saving some more? It also then starts defining, well, how do I want to start investing? If I need to start pulling out $120,000 a year in 6 years and then 7 years and then 8 years,
Yes.
how do I want to invest that money? How does that make sense? But equally, I want to have that money to support me for my lifetime, and maybe there's other things that I want to do beyond that, helping the children out as well. So if I think about those things, do I need some growth in the portfolio, and then maybe I need something that's a little bit more conservative there for myself as well. And then
So there's thinking about, what do I actually want my investment in my assets to do? Point number one. Fantastic.
having an agenda for that asset is really important, because once there's no longer a purpose for that asset, then you start thinking about, what should I sell it?
Okay.
And that can be helpful in terms of getting underperforming or potentially underperforming assets out of a portfolio. Because in investing, there's a concept of opportunity cost. I can own this, but I can only own 100% of something. So am I owning this or this, and what does that mean? And that might be driven by the purpose or the use case of that asset. So that's one thing that's really important. And then when you're investing, it's easy to see returns and what returns have been, but having a good understanding of, what am I actually invested in? I can have a good think about what are the risks.
Well, even as simple as whatever you own may have some capital growth, and it might be down because the markets are down, but it's still giving you a very good return on that actual, you bought 1,000 of something. Yes, the value of the 1,000's down, but it's still producing 8% or 6% or whatever. So your asset is still producing an income for you, isn't it?
As long as the forward-looking investment thesis for that investment, whatever it is, remains robust.
Yes.
Right? There's no point owning something if the whole thesis is broken, whatever, whatever it might be, right? But as long as, volatility happens, like, like CSL.
Yes.
Short-term volatility happens, but if you've done your work, either yourself or outsourced to the investment specialist, if the forward-looking investment thesis remains strong and robust and companies growing, etc., then you can. That should
where
be
the volatility
should be a judgment to just continue on with that investment regardless of this period of short-term volatility, right?
Sure.
And
there might be other cases where you do need to move on because times have changed. You know, AI has made a business redundant, etc. There can be reasons to move on as well.
And the other thing, if someone's investing for you, are they the best group they're positioned to invest for you? So coming back to the governance, what's their capability? What's their tenure in that market been? Is it one person? Is there multiple people? If things go bad, what happens? Is there regulatory oversight there? What is the governance around that as well? Because again, sitting in a front bar, people have great ideas. They can know a friend of a friend who's getting this high rate of return of just lending money, and it might be going through a property developer. If someone's giving you 10% return, someone's needing to borrow for more than that, and you start to wonder why they need to borrow at 12 to 14% rather than going to the bank at half than that.
Yes.
And what the risk is there. And for some people, it might be fine because they might be first mortgage holder and they might be okay with that. But if that gets triggered, and it gets triggered broadly across the portfolio, is that when you're going to want to have a whole heap of property now on your book? How many cents in the dollar are you going to get back? And is that the trade-off for that income return? So it's ensuring that there's that strong governance around what you're investing in, because things can go wrong and they can go wrong quickly. So it's going into things eyes wide open and having good understanding of what you're getting yourself into.
If you're only listening and not watching, you'll know, well, you won't know, but two of us have grey hair and one doesn't have any grey hair. So Robbie, have you found it? I'm sure you would have that expertise and experience around the table when you go into these investment meetings where, as a young buck, it's easy to come in and say, we've got to pile into this. And you'll quite often have the grey-headed guy go, that's a great idea, Robbie, but
He's older than he looks.
Oh, and life's been kind to him.
No, you look with investing. You always know that there's a lot that you don't know, and I think once you appreciate that, it's humbling, but it does open your eyes as well, because invariably you're looking at the future. You could have a portfolio that's done really well. Oh, well, that's great, but you're interested in what it's going to do going forward, and nobody knows what's going to happen going forward. What's going to happen in Iran? These types of things. So, how do you ensure that you have a portfolio that is robust for that? And sitting around a table with people who've been through various markets and have various pools of experience, that's really important to us, and that's why we don't just in-house things, because if we're able to bring skills and capability to the table that come from different parts of the market with different experiences, and they have different clients with different requirements, and they're having different discussions as well, we're able to pull all of that capability and knowledge together to put our clients in the best position possible. Fascinating
chat. I could chat all day. I will have you both back on and we continue this chat, but we've been listening to Stick With It, and today we've been joined by Stephen and Robbie from MGD Wealth. Thank you both for your time. Thoroughly fascinating.
Yeah, appreciate the opportunity, and good to catch up again, Andrew.
Thanks,
Thank you very much.
Andrew. Thanks, everybody.
Thank you.
Cheers.
MGD Wealth, a fantastic partner of APA. Here's your chance. Pick up the phone, jump online. Thanks for listening, and remember, always stick with it.